Major indices bounced on Friday but snapped a multi-week winning streak, ending September with rare gains in the historically most tough month of the year. President Trump announces sweeping new tariffs on imported pharmaceuticals, furniture, and heavy trucks, sparking sector volatility. And October volatility looms in front of us as analysts warn the market may face heightened swings, followed by September's bullish anomaly. Stay with us. This is the CB3 Financial Weekly Podcast update, and it begins now. Markets started last week on a high note. On Monday, the S&P 500, NASDAQ, and Dow all set closing new high records in September. That continued September's surprising strength. So historically, September is the worst month of the year, the only one that averages a negative return over the last 70 years. But this year, 2025, the market confounded the pundits and September finished up. As the week progressed, however, enthusiasm faded. 3 straight days of selling driven by profit-taking and sector rotation wiped out some of the month's gains, but Friday, the markets found their footing again as inflation data came in broadly as expected, but it wasn't enough. The S&P 500, NASDAQ, and Dow all recorded losses for the week, but still finished up on the month of September. So that is good news for us. We are still fully invested in all of our programs. We believe heading now into the fourth quarter, starting on Wednesday, October 1st, we are very well positioned for additional gains. So here are the highlights from last week's trading. Inflation data and Federal Reserve signals are what we are watching. The personal consumption expenditures, the PCE index, as it's known, the Fed's go-to inflation measure, rose 2.9% year over year. That means on a trailing year basis, and 0.2% for August. Both of those readings match the forecast. When we match the forecast, that's good because that encourages the Fed to know that we are not increasing inflation, even if we're just staying where we are. And that, I hope, gives them an incentive to continue to forecast rate cuts going forward. Traders read the steady report as a sign the Federal Reserve will maintain its cautious approach well into the year end. Now, there were some rapid swings in sectors. There are 11 sectors in the S&P 500, and we saw these rotations happening Thursday and again on Friday. Domestic manufacturers and suppliers saw stocks pop, while global drug makers and high-end furniture makers and foreign automobile makers sharply traded lower. And again, this is all tariff-based. You've seen the news about President Trump now wanting to tax certain specific industries in the drug makers, furniture makers, that's high-end furniture makers, and then foreign automakers, basically trying to continue to try to level the playing field for U.S. manufacturers being given the opportunity to sell their wares overseas. So September, as I said earlier, did end on a high note. Remarkably, the worst calendar month of the year throughout market history, at least going back to 1950, delivered solid returns this year. And I believe this sets us up very well heading into the fourth quarter. Why? Because October, even though it's the most volatile, so September is the worst performing month historically, October is the most volatile month. The market crash of 1987, 2008, a lot of these big market downturns and then snapbacks happened in October. November is historically the best performing month of the year. December is second. April is third. I won't go through all of them, but you get the idea. So most experts anticipated above average volatility and losses, but strong tech performance and resilient consumer data powered an unexpected rally, and that's why September closed up. While market breadth remains an issue, meaning we just don't want the Mag 7 and the gazillion-dollar stocks out there making all the gains, we are seeing more participation in all 11 sectors, although it's still not as wide a participation as we want to see here at CB3 Financial. So September's bullish move is clearly an anomaly. That's okay. It caught a lot of the pundits off guard. That's okay. We remained fully invested throughout the month. So let's look ahead to October. With September closing on a positive note, remember I just said a rare feat, attention now turns to October, long known as the most volatile month, which I said earlier, but I just want to drive this home. There's a difference between the worst performing month in September and the most volatile in October, and both of those 2 months, September and October, lead into November and December, traditionally the strongest months, and a lot of that is because of Christmas sales and just end-of-year sentiment. All right. Multiple historic crashes and wild swings have occurred in October, and then things calm down after that. So expect this heightened volatility here in the month of October as we enter that on Wednesday. Earnings season brings renewed focus on forward guidance. So we finished the third quarter, which means now the earnings are going to start to be reported along the 10th or 11th, 12th of October, and then they come in earnest by the end of the month. And political wins, including budget negotiations and tariff impacts, make the headlines and move risk assets. They can move it up or down. So the tech sector remains a battleground with evaluations and rotations into defensive sectors gaining some steam. I don't expect that to perpetuate, though, much past the end of October, again, because I still see pretty smooth sailing November and December of this year. So for the post-election Octobers, they often buck the bearish trend and deliver positive returns, offering some hope despite the warnings I'm giving you here. Investors should track defensive names. If you want to watch, if we're doing any rotating, we're trading now on monthly signals. So we've already made our trading decisions for the month of October. We may be making additional decisions for November, but we'll have to wait and see how October performs before we let you know what's happening there. So thanks for tuning in, guys. I hope this has been helpful. Be sure and go back and listen to September's CB3 Live. We spent a lot of time talking about the Schwab move, and many of you are clients that listen to this podcast. If you're not a client, it may not interest you much, but if you are a client, definitely take the time to listen to that. We actually excerpted that, meaning we pulled out that segment and it has its own video on the CB3 Live website. So thanks again for tuning in. We will be live on October 9th with the next episode of CB3 Live. Hope to see you then. Hope to hear you then. And until then, enjoy autumn. Realize that this time of year usually is very productive for the market. All right. It may be volatile in October, but November and December tend to be really good months, and we will be positioned accordingly. Thanks for listening. We're your portfolio manager at CB3 Financial. See you next time.